Welcome to earnings season, and it's welcoming with a sell-off, coming off of a strong week of gains. Here with us at Post 9 is Tony Crescenzi, Portfolio Manager and Executive Vice President at Pimco, and Paul Christopher, Head of Global Market Strategy at Wells Fargo Investment Institute. Just lowered, by the way, their 2019 estimates, Paul. Is it because all these companies are coming out and giving some mixed signals on guidance?
We're looking at the macro picture and seeing growth a little bit slower than we thought it might be, and there's probably some feedback loop negative from all the bad sentiment in December feeding through into consumer sentiment, business sentiment. You may see that reflected in these earnings reports as far as future or forward guidance from these companies, and yeah, that's why we took our numbers down.
Interestingly, Paul, financials are the only group that's actually in the green. Citigroup is up 2% despite the revenue miss. I mean, does it tell you anything about what's already reflected in these stock prices, even to get some hiccups around earnings?
Yeah, it's a very interesting point you make. Financials have really been taken out behind the woodshed and thoroughly thrashed. It's possible that now we're beginning to see some bargain hunters come into some of these sectors. I think it's likely very soon that we'll see most of the slower growth expectations be finally priced in, but we may be starting to see that in financials.
How slow is growth slowing, Tony?
To a level that's more sustainable. Remembering growth in 2018 was about 3%. The Federal Reserve itself believes that the most the economy can grow on a sustained basis is about 1.8%. Why? Because the population doesn't grow very fast, about 0.5% per year in terms of the labor force changes, half of the old rate, and productivity is only about 1% or so. And so the economy can only grow in the high ones. It's been growing in the high twos. So it's actually necessary to see this slow down in order to sustain it. If growth had stayed at 3% in 2019 and 2020, it's most likely the jobless rate would fall toward 3% from the current 3.8. And the wage figures would move up in a way that makes it less profitable for businesses, and there'll be a little more inflation and higher interest rates. And so this is the type of pause that could refresh and help sustain the expansion in the longer run.
Now, you're talking about the U.S. here, but are there signs as well of a synchronous global slowdown?
Without question, but when we think of global nominal GDP, let's call it about 3% for real GDP and inflation about 2.5%, it's still consistent with changes in global corporate profits of double digits. So it's still a favorable story. The worry is, of course, that there'll be a feedback loop from all of the recent weakness in markets to hurt the economy. This all started with political factors, call it Brexit, China and Italy. It morphed perhaps into a market problem that could feed back into the economy and cause additional market problems.
The China problem is real, isn't it? I mean, there is a significant slowdown there. It is the second largest economy. There is quite a feedback loop there from
right, and very important because it's the biggest contributor by far to the world economy. A $13 trillion economy growing at near 6.5% is $800 billion of new GDP for the world. The U.S. economy is $20 trillion in size, growing at 2.5%. That's $500 billion of new GDP for the world. So it's China that really matters when you think of the global picture on growth.
Pimco's been pretty wary of a U.S. recession, would you say?
We'd say more for slowdown and cautiously optimistic we'll get through this.
I'm looking at Fell's comments last month about flashing
Fell's
orange.
Excellent comments in our recent write-up for our quarterly cyclical forum. But we do think growth continues. We need to get past these political issues that are causing problems in markets and could feed back into the economy. But generally speaking, we were expecting a slowdown. In fact, we had an article written by Joachim Fels and Andrew Balls, one of our CIOs, over a year ago called Peak Growth. We thought growth probably had peaked. But there's a huge difference between a slowdown, synchronous slowdown, and a global recession. We're not calling for that, but we would be investing very cautiously from the bottom up, looking at individual situations rather than getting a high equity and credit beta. In other words, don't simply get on the bandwagon thinking you're going to fare well.
So we've got a slowdown, Paul. We've also got this shutdown. And as President Trump said at the top of the hour, very little indication that it's coming to a close. How do you think about what it means for investing? Do you have to look at certain impact on industries, on the broader economy? Give us the latest read.
Yeah, in the broader economy, it probably accounts for a tick or two, maybe a quarter of a point in GDP growth if it's extended very long, but we don't think that's going to happen. The macroeconomic impact is probably pretty small. It's the psychological impact that's larger at this point and probably gets investors thinking about what happens when debt ceiling negotiations have to come up closer to mid-year, and will we still be at odds at loggerheads the way we are right now between the House and the White House?
Is that a real concern at this point, Tony?
It's the uncertainty factor. Markets every day, forever, have to deal with, in the past and in the future, will deal with uncertainty. But there's a huge difference between ordinary uncertainties and the type that markets can't estimate and figure out. It's called a Knightian uncertainty after Frank Knight, a book of 98 years ago on risk, uncertainty, and profit. There's a huge difference between the risks we can measure and those that we can't. Think of an insurance company really fast. Every day there are car accidents. They have an idea, a sense of how many there'll be. But if there's a comet headed toward the Earth, they can't estimate, and there'll be a huge difference in behavior.
Finally, these Yellen comments today, talking about potentially we may have seen the last hike of the cycle. How much weight does she have still?
Well, not in terms of influencing policy, of course, but her judgment is certainly probably spot on and certainly valued by those who are within the monetary policy circles. It is possible. A March pause is highly probable. A June hike is plausible if conditions change on the political front and if the economy shows it's resilient through all of this. But we wouldn't look for much more than one.
Is going down.
Right,
Up,
so the
right?
Fed can afford to pause, and there's absolutely no basis for a hike anytime soon. And so the idea that we've seen the last hike is very possible.